All right, guys, Kody Houk, PrimeRisk back, part 6 of the book. We are going to talk about controlling your costs without cutting coverage and how we can achieve this. And some of this is going to be a little bit of a recap from other chapters that we're going to lump back into this and show you how it helps you control cost. But here's how we're going to start talking about some cost savings. Number one, especially with the state of the insurance market for the last few years, is the easiest way and fastest way to cut costs of your insurance program is for you to have a little bit of skin in the game. I'm sure you guys are familiar with the term deductible or retention on your insurance policies. That is the amount that you are responsible for in the event of a claim. Okay, so say you have a $1,000 deductible and you have a $10,000 claim, you're going to be responsible for $1,000 of that. The insurance company will pay the other $9,000. Here's where we get into some cost savings opportunities. Is one, we should be avoiding small claims when possible. And that's going to look different for every company. So you, your leadership team, your finance department, whatever and whoever needs to be involved in that decision, all need to sit down together and decide we are willing to take this amount of risk in the event of small things happening. I have some companies that number is $5,000. I have some roofing companies that number is $50,000. They have a $50,000 deductible. Anything under that, they pay for themselves. And even if it's slightly over that, they're willing to pay for that themselves. But they take that amount of risk to bring their insurance costs down. Now, you need to evaluate that carefully because let's say you have a $50,000 deductible. Let's drop that down. Let's say you have a $15,000 deductible. And God forbid you have 3 or 4 claims that year and now you had to shell out $50,000, $60,000, $70,000 out of pocket to cover claims. Can your company financially sustain that? And what was the cost savings on insurance for raising your deductible that high? Again, we want to encourage you to take care of things out of pocket when you can because that reduces frequency of claims on your policy, which also keeps your rates down because if you are filing claims, no matter how big or small, if you're doing them frequently, insurance companies are going to jump your rates like crazy because you're costing them money. Again, going back to chapter 1, talking about that risk transference. If you pay a company $50,000 a year for your insurance and they've cut $300,000 of claims checks on your behalf, they're going to raise your rates for that. And the other insurance companies, even if you go to switch, want your loss runs or your claims history, and they're going to see that that's what you did, and then they're going to bump your rate up if they offer you coverage as well. Looking at your deductible or your retention is incredibly important, okay? Looking at your limits. Some limits on your policies can be adjusted, all right? Your typical GL policy is going to be $1 million per occurrence, $2 million aggregate. That we don't write anything lower than that at all. You can get coverage lower than that, but one, you're not going to be contract compliant if you are doing any work for commercial work, any other GCs or contractors that you're working with. If you're working for property management companies, they all require a minimum of that 1-2. And you're starting to see more and more the excess and umbrella coverage come to play in this, where a lot of them are wanting a minimum of $2 million. If you're doing commercial work, they're going to want a $5 million umbrella on top of that. But you can look and see things like your damage to rented premises, your medical pay, looking at things like that. I don't recommend going low or eliminating those at all because those are coverages that do come into play if you're renting, say you're a tenant in a space. The term that you'll see for that damage to rented premises is also sometimes swapped out for fire damage, that if you cause damage to the space that you're in, that is the sublimit on your policy. You don't have the full $1 million of coverage, but a lot of policies could be between $100,000 and $300,000, and you can bump that up. But looking at your coverage limits, there are specific risks or situations that you might not need covered, okay? If you never leave a roof exposed, pull a roof off a house and leave it exposed overnight or for long periods of time that you're not there to take that, maybe you take the risk of the open roof exclusion. Not something I recommend, and I don't write policies with it, but those are risks that you're willing to take if you feel that it's a very small risk and you're willing to take it on as a company and take on that financial risk, and you can do it, right? If you don't need a lot of additional insured, waiver of subrogation, things that make you contract compliant, if you're only doing work for yourself and you're not having anyone sub you out or having commercial builders or developers or other GCs hire you. A lot of agents, we do it. We put what's called blanket AI and waivers on the policy because it makes it convenient for you as the insured to quickly get certificates. And a lot of times if you are doing that that extensively if you have more than 5 people that need certificates and they need the additional insured and waiver and things like that. It's more cost effective to do the blanket than it is to individually pay for them. But if you only need 1 or 2 a year, maybe you individually pay for your AIs and waivers rather than having blanket on the policy. Okay, so having skin in the game is important. Looking at the coverages and endorsements that we've put on the policy is important. Looking for available discounts. Okay, is the building sprinklered, alarmed? Do you have telematics on your auto insurance, or are you willing to do that? Do you have dash cams front and back? Do you have driver monitoring, low jack things, theft prevention on the vehicles? All documentation that you need to keep and send to your agent so they can negotiate these rates on your behalf. A lot of times your Progressive, Geico's, companies like that aren't going to give you any credit for that kind of things unless you're using theirs that they're actually providing you. But if you've installed your own and you've taken that proactive action and you have the documentation to give to your agent, then your bigger companies like Liberty Mutual, Travelers, Hartford, they will take into consideration and give you credits, right? They don't actually show on your bill as discounts, but they have credits available that they can give you and actually lower that premium. And then keeping records of your safety programs. Very important. Document all of your safety programs. Send those to your agent so they can send them in with your yearly submission to get and maximize the credits that you're eligible for. Lastly would be similar to home and auto. A lot of companies provide paid in full discounts if you can afford to pay your policies annually, especially if you are in specialty markets where you have to use a third-party finance company. You can save a lot of money, in thousands of dollars a year by being able to pay that policy, because those policies aren't billed directly to you. The agency has to get a finance company in the middle of that, and your APR on that's going to be typically anywhere from 12 to 20% that you're paying in interest on whatever it is that you're having to finance outside of your down payment. So being able to pay those policies in full will save you some money every year. When it comes time for renewal, again, starting early, we want to get out ahead of this process so your broker has time to go to multiple companies, negotiate on your behalf, present you in a light that is favorable to the insurance companies. And what we try to do is get these companies bidding over you, especially if you are a safe company and they see you as a company that they want to insure, because let's be real, they're all in it to make money, just like you're in your business to make money. If they can provide you insurance and collect your premiums and not take a large risk of claims being paid out, and they can be profitable on you, they're going to give you better rates. We just cut and dry talk it like it is, man. This is business. All of these companies, none of them are in business to lose money. They're there for you when you need them, but their goal is to make money. So we negotiate on your behalf. We try to get multiple carriers interested in insuring you and go back and forth between them to try to drive the rate down the most that we can. Okay? Highlighting your improvements and the growth that you're having in the company year over year, both from a financial standpoint of we've grown our sales, but also talking about how you've grown in a culture of safety and risk management. Incredibly important. And you can also push back on some unclear increases. All right? If you've been safe, you've had no claims, you've actually increased your safety offerings and taken your risk management more seriously, but you've seen an increase without an increase of sales or payroll, because let's remember, your insurance premium is based on your sales and payroll. You pay a rate per 100 or rate per 1,000 of your sales or payroll. Our job is to get that rate down, not necessarily the premium if you've grown. We try to get that rate per 1,000 or rate per 100 down. But if you've seen an increase in that and there's no justification behind it, give some pushback. Okay, one, your agent should know to discuss that with you, number one. Number two, we have negotiating power on the commercial side that doesn't exist on home and auto. So push back on some of those rate increases. Okay, some other things that we can talk about is making sure that your class codes are correct, that there's nothing getting misclassified, especially when it comes to work comp. We see that quite a bit. There's errors made in code classification when it comes down to audits. So making sure that those are correct and that they're rated properly. Another one would be, I briefly mentioned it in another module here, would be having that return to work program or light duty program. Okay, and you might think, well, I'm not going to pay this person for sitting in the office or being off. Well, in the long run, having a work comp claim, again, just be medical bills only rather than having to pay for them to be off work. You get credits back on your work comp for doing that. So in the long run, it's cheaper to develop that light duty program, even if it's at a lower rate than their standard rate of pay, and say have them come in and file paperwork, do some computer work, just drive around doing QA, whatever that looks looks like, get them back to work and have that return to work program documented so we can get that to the insurance company and show that you have that in place. We can dive into some other things if you're large enough, if you're paying more than $250,000 a year in insurance, talking about captive programs and ways you can actually earn premium back and things of that nature. I think that's a little too convoluted for this video series. We'll probably do a little deeper one on that if you guys drop that in the comments if you're interested in that. Again, all of your premiums combined have to be at least $250,000 to talk about those. But if that's something you want to connect on, drop that in the comments and I'll make another video about that, or we can connect private for a one-on-one call and see if that would make sense for your company. But we're going to go ahead and end this one here because I think I've given you enough, and we'll see you on the last module.